Today, we need a QE inquiry now. The DFA Daily to the 15th of September 2021. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. In today's show, we discuss the latest home price data from the ABS, the RBA's view on future interest rates, and why we need a thorough policy review, what's happening with Evergrande, which some are suggesting is a Lehman 2.0, but I have my doubts, and more broadly, the economic fallout of Delta. Both residential property prices and the total value of residential dwellings recorded the largest quarterly rise on record, according to the latest figures from the ABS, which was releasing its numbers to June 2021. The residential property price indices for the 8 capital cities showed that residential property prices rose by 6.7% in the June 21 quarter. That's represented the strongest quarterly growth since the index series began in September 2003. All capital cities recorded price rises in the June quarter, while prices rose at rates not seen in many years in all cities except Perth and Darwin. For instance, Canberra recorded the largest quarterly rise since the series began in September 2003, up 8.2%, while Sydney had the largest quarterly rise since the June quarter 2015 and the second largest in the series, up 8.1%. Meanwhile, Hobart was up 6.3%, and that was the largest quarterly rise since the December 2003 quarter. Melbourne was up 6.1%, and that was the largest quarterly rise since the December 2009 quarter. Brisbane was up 5.7%, and that was the largest quarterly rise since June 2007, and Adelaide, up 5.3%, was the largest quarterly rise since December 2007. House prices rose by 7.7% across the combined capital cities in the June quarter, while attached dwelling prices rose by 4.3%. Canberra was the only capital city to experience record quarterly growth in both the house price index, up 8.9%, and the attached dwelling price index, up 6% in the June quarter. And the total value of Australia's 10.7 million residential dwellings also recorded the largest quarterly rise on record, jumping by $596.4 billion to $8.9 trillion in the June quarter. Of that, over $8.5 billion was owned by households. The value of residential dwellings in New South Wales in the June quarter was $3.6 billion, around 40% of the total value of dwellings in Australia. The mean price of residential dwellings in Australia rose by $52,600 to $835,700, and New South Wales recorded the highest mean price in the country at $1.1 million. Meanwhile, the ACT recorded the second highest mean price at $891,700, and that exceeded Victoria's mean price for the first time since March 2015, albeit only marginally at $891,500. Commenting on the record property price trends, ABS head of price statistics said the continued growth in property prices was occurring at a time of record low interest rates. Persistently low levels of stock on the market were being met with strong demand and properties transacting at an increasingly rapid rate. With the exception of Hobart and Darwin, capital cities continue to see house price rises outpace those of attached dwellings, such as apartments and units, with price growth for both property types being driven by the upper segments of the market. Now, it's worth noting here, of course, that this is very important to understand. There's a big difference between units and houses, particularly the upper end of the market, and those dog boxes that are being sold to investors. They are still going backwards. So you have to go below the headline to really understand what's going on. But apart from the obviously silly monetary settings, which have driven the fact that the home price phenomenon is really mad, this is a canary in the coal line too, because it's actually reflecting on 30 years of failed policy. I've been saying for some long time now, we need a thorough review, not the Mickey Mouse supply side inquiry currently underway. I'm not alone. Independent reviews of the Reserve Bank of Australia and the federal budget are needed to deal with the pandemic legacies of near zero interest rates on more than $1 trillion of public debt, according to the OECD. Emergency money and fiscal stimulus supported the economic recovery from COVID-19, but there are some areas that could be improved, they said, in the institutional framework that govern interest rates, government spending and taxation. As the economy recovers, the government's medium-term fiscal strategy should be more detailed, and an independent fiscal watchdog, such as the Parliamentary Budget Office, have its powers strengthened to regularly scrutinise the budget, the Paris-based Club for Wealthy Countries said. The RBA's overly tight monetary policy before slashing rates during the pandemic had contributed to undershooting the 2 to 3% inflation target for the past 5 years. That's according to the OECD's 135-page economic survey of Australia. A review into the monetary policy framework should be undertaken and the fiscal framework buttressed, the OECD said. The immediate fiscal expansion was one of the largest in the OECD, and the Reserve Bank of Australia cut official rates and embraced an array of new policy tools, including purchases of government bonds. Legacies of the pandemic in the form of higher public debt and limited monetary space will present challenges for macroeconomic management going forward. The recommendation recognises that in a near-zero interest rate world with limited RBA firepower, the government's increasingly indebted budget could be forced to provide more financial support in future economic downturns. Fiscal policy is now operating in an environment of higher public debt and will now shoulder more of the burden in managing cyclical fluctuations, said Ben Westmore, the head of the OECD's Australia desk and a former RBA official. RBA Governor Philip Lowe has resisted calls from academic economists and former RBA officials such as Bruce Preston and Peter Tulip and Shadow Treasurer Jim Chalmers to commission an independent review of the RBA, like other major central banks in the world have done. Others, such as a former RBA board member Warwick McKibben, have called for inflation targeting to be replaced by a nominal GDP target. The OED said, now would seem like an appropriate time for a review of Australia's monetary policy framework, given the institutional and structural changes that have occurred in the economy as a result of the pandemic and the unconventional policy instruments the RBA has begun to employ. Such a review should be broad in scope, potentially including a review of the central bank's mandate, policy tools, methods of public communication, hiring processes and internal structures. It could also consider the alternative paths for rebuilding monetary policy space from the current position of policy rates at the zero lower bound. And this is all in line with the recent House of Lords review of quantitative easing in the UK, which was executed by the architect of QE a decade ago there, which suggests the Bank of England has lost the plot and the true agenda is keeping borrowing costs low at all costs for government, never mind the impact on the real economy. Yet Philip Lowe pushed back against investors betting on early interest rate increases, arguing it will take time to drive faster wages growth, and reiterated he doesn't expect rates to lift before 2024. I find it difficult to understand why rate rises are being priced in next year or early 2023, Lowe said in a speech to the Annika Foundation on Tuesday. While policy rates might be increasing in some other countries over this time frame, our wage and inflation experience is quite different. Australian overnight index swaps show some parts of the market still doubt the Reserve Bank's guidance. While South Korea raised rates and New Zealand is set to follow, both central banks are also trying to temper surging asset prices. The RBA has made it clear that it won't be using monetary policy to cool the housing market, with regulators likely to use macroprudential rules instead. Lowe is trying to use a record low 0.1% cash rate to tighten the labour market and spur faster wages growth, a goal interrupted by an outbreak of the Delta variant of coronavirus that's forced half of Australia's population into lockdown. Even before Delta, Australia's strongest industries showed only modest labour demand. The governor says it will take some time for pay gains to reach a level that will drive faster inflation. On the impact of lockdowns on the labour market, Lowe reiterated that hours worked were likely to take the bulk of the hit, and he added, however, that with unemployment, it would not be surprising to see readings in the high fives for a short period of time. The jobless rate was 4.6% in July, and economists predict it rose to 5% in August because of stay-at-home orders. Australian policymakers last week pushed ahead with a tapering of weekly bond purchases to $4 billion from $5 billion, while extending the duration by 3 months to mid-February. Given that the recovery has been delayed, we considered it appropriate that we delay, Lowe said. By February, we will know more about how the economy is responding to the easing of restrictions. Asked about policy sequencing, Lowe said the bank will conclude its bond purchases once inflation and employment are on track to reach their targets. Once inflation has sustainably returned to between 2 to 3%, the RBA will begin raising rates. The highly contagious Delta variant has prompted New South Wales and Victoria to abandon COVID-0 policies and instead seek to hit vaccination targets and try to live with COVID. Lowe said a source of uncertainty is how Australians will respond to the eventual easing of restrictions, given that the loosening will likely take place with the virus still circulating in the community. This is quite different from our early experience when the number of cases was close to zero and there was a very quick bounce back, he said. The RBA is expecting the economy to recover in the final 3 months of the year from a contraction this quarter of 2% or possibly significantly larger. And China's government is assembling a group of accounting and legal experts to examine the finances of China Evergrande Group, a potential precursor to a restructuring of the world's most indebted developer. Regulators in Evergrande's home province of Guangdong dispatched a team last month from King & Wood Mallesons, a law firm whose specialities include restructuring. At the urging of Beijing, provincial officials are also sending additional financial advisors and accountants to assess the developer. The move adds to signs that Chinese authorities are laying the groundwork for what could be one of the country's biggest debt restructurings. While senior leaders in Beijing have yet to indicate whether they would allow Evergrande creditors to suffer major losses, bondholders are pricing in slim odds of a rescue. Guangdong officials had turned down at least one bailout request from billionaire Evergrande founder Hu Kaiyan, who owns a controlling stake. Evergrande said on Tuesday that the company hired its own advisors and they are there to assess the group's capital structure and to reach an optimal solution for all stakeholders. The disclosure came in an exchange filing outlining the dire state of the company's finances, with Evergrande warning that it faces tremendous liquidity strains. The company's shares fell 12% in Hong Kong, extending this year's drop to 80% and closing at the lowest level since November 2014. Evergrande's 8.25% dollar bond due 2022 dropped about 5.5 cents to 27 cents, pricing in a likely default, according to Bloomberg data. Pressure is building on the Chinese authorities to find a resolution to a month-long crisis that has intensified markedly in recent days. The developer is falling behind on commitments to suppliers, retail investors and homebuyers, raising the spectre of social unrest after a spate of protests at Evergrande offices across China. And protesters gathered at the company's Shenzhen headquarters for at least the third straight day on Tuesday, braving the rain to demand repayment on overdue wealth management products. The extent of the losses facing investors will depend in part on whether Chinese authorities and state-run banks take steps to limit the fallout. Evergrande, which has about $300 billion of liabilities, has emerged as the biggest test yet of President Xi Jinping's willingness to let over-indebted companies fail as he tries to wring the excesses out of China's $54 trillion financial system. Without state intervention, the risk is that Evergrande enters a downward spiral. The developer said in its statement on Tuesday that property sales will drop in the normally buoyant month of September because of waning confidence about home buyers who often need to give the company large down payments of properties that may take years to complete. Evergrande said it hasn't made material progress on plans to sell stakes in electric car and property service units, adding that the planned disposal of its Hong Kong headquarters buildings hasn't yet been completed as expected. Asset sales have been one of the most important pillars of Evergrande's plan to escape its cash crunch. Guangdong's government has encouraged Evergrande's major banks to set up a creditor committee, a move that would allow lenders to take over major decisions, including asset disposals. The banks are reluctant to do so before getting a clear nod from national regulators. China's Financial Stability and Development Committee, the nation's top financial regulator, gave its blessing to an Evergrande plan last month to renegotiate payment deadlines with banks and other creditors on a piecemeal basis. It's unclear whether recent developments, such as the investors' protests, have caused Beijing to reconsider. Evergrande, which denied rumours late on Monday that it would file for bankruptcy, said on Tuesday that they would explore all feasible solutions to ease the current liquidity issue. King & Wood, the law firm tapped by Guizhou Province, is one of China's biggest providers of insolvency restructuring services and has been involved in high-profile cases including HNA Group, Brillianz Auto Group and China Fortune Land Development Co. It looks like they're working on debt restructuring after no concrete results on asset disposals, and the first task is to stabilise the holders of wealth management products, which could be a social issue, said Daniel Fan, a credit analyst at Bloomberg. It seems the developer is working on rescheduling pretty much all onshore debt, and the next step is to do the same for offshore investors. While the developer doesn't have any bonds maturing until 2022, it faces $669 million in coupon payments this year, including $83.5 million due in September for a dollar note. Fitch Ratings highlighted an increased chance of default on these interest payments when it slashed Evergrande's rating deeper into junk territory last week. It will be increasingly difficult for Evergrande to pay out on offshore obligations, said Hao Chan Wan, head of Asia fixed income at Principal Global Investors. It seems to us the priority now would be to go for an orderly restructuring and manage claims in an organised fashion. But I don't think that Evergrande is of a size and stature of Lehman's, at least not yet. And COVID-19 isn't still done hobbling the global economy. From the US to China and Germany, the latest data is flagging an economic slowdown as the new form of the virus hits spending, just as supply chain snarl-ups threaten to keep inflation elevated. China locked down a city of 4.5 million people in the southeastern province of Fujian after detecting a dozen coronavirus cases, an attempt to once again halt a Delta outbreak and maintain its strict zero-tolerance approach to COVID-19. Residents of the scenic coastal city of Xiamen, a manufacturing hub for electronic components, from companies including ABB Limited and Schneider, according to the city's almanac, were banned from leaving other than in exceptional circumstances. All residential compounds and villages are closed off, while leisure venues in the tourist city, including cinemas, bars, gyms and libraries, halted operations, city officials said in a press conference on Monday. The latest outbreak, which has yet to escape the Fujian province, includes 103 cases in 3 cities thus far. The first cases were detected in 2 students from local schools through routine testing. Their father, who returned from overseas in early August, was also infected and is considered to be the likely origin. The wave comes less than a month after China fought off the broadest outbreak in the country since the virus first emerged in Wuhan. The fast and furious measures taken by local authorities reflect the difficulty of containing the more transmissible Delta variant and the escalation China needs to undertake to sustain its COVID-0 status. Both the world's 2 largest economies, in fact, are feeling the squeeze. The US economy is on pace for a 5.8% annualized quarter-on-quarter expansion in the current quarter, according to Bloomberg's data, now down from 6.6%. In China, the Bloomberg nowcast is tracking at 6.1% year-on-year, down from 7.9% in the second quarter. Its economy is dealing not just with Delta, but also with a government crackdown on high-polluting industries and potentially a blow to business confidence from the new Common Prosperity Agenda. The deaccelerations are faster than what economists previously expected and leave central banks and governments facing a challenging combination of slackening recovery and stubborn price pressures. We're not at panic stations. The data is pointing to a softer recovery, not a reversal, said Bloomberg. Still, the latest nowcast readings are a reminder that the virus remains a significant negative and hard-to-predict variable impact on the outlook. With recoveries losing momentum, GDP in most major economies is struggling to regain the pre-virus trend. From US retail sales to China factory output, the Bloomberg nowcast unites hundreds of data points to provide a high-frequency read on the pace of growth and level of inflation across major economies ahead of the official data. The latest readout from the major economies shows output poised to end the year with still some distance short of the pre-COVID trend. In normal times, that slack in the economy would mean inflation remains subdued, but in the topsy-turvy world of the COVID recovery, that's not the case. Supply chain strains, high shipping costs and elevated commodity prices mean that even as output remains below potential, inflation in many countries is above the target of central banks. The good news for the third quarter is that the nowcast points to a peak and the beginnings of a decline for the US Consumer Price Index. The bad news is they suggest the euro area and UK will see inflation above central bank's 2% target. The picture in China looks a little different. Factory gate prices gains are sky high. So far, though, consumers haven't suffered a sticker shock in the shops. Even as US inflation peaks, price gauges in the euro area and UK are moving above target. For the world's biggest central banks, a recovery losing momentum and inflation elevated means a complicated situation. A weaker recovery means pressure to add stimulus. Stubbornly high prices means pressure to withdraw it. The combination of the two is reminiscent of the stagflation last seen in the 1970s, and leaves Federal Reserve Chair Jerome Powell, the European Central Bank President Christine Lagarde, and their peers with few easy options. The latest decision by the ECB provides an illustration of the predicament, despite a recently concluded strategy review promising forceful action to reinflate the economy. Lagarde last week announced plans to slow the pace of bond buying, and in China, the central bank faces a different trade-off between supporting growth with easier policy and tamping down risks of a credit bubble with tighter. The latest signs suggest its growth will be the priority, with expectations of a move to free up funds for banks to lend in the months ahead. The world's most important central bank, meanwhile, sliding growth and still high inflation, hasn't yet changed the policy calculus. Powell is still on course this year to announce a slowing of the Fed's massive asset purchase program. Still, the path was made bumpier by weak hiring in August, and with Delta still spreading and supply chains still snarled, the Fed's policy path to taper and beyond is hedged with uncertainty. And of course, the CPI that came out today from the US showed that, in fact, it was a little lower than many expected. So, adding further confusion to the mix. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.